Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing hedging using the Elliott wave setup. Continuing with our hedging strategy series, today we are going to be looking at two trades. One which involves the Elliott wave theory of technical analysis, and should this prove ineffective, we will also be using a secondary hedging or insurance-based trade in the event that our first trade does not go according to the technical analysis. While hedging comes in many forms and strategies, the methodology behind this type of hedging is that we want to carefully create a trade setup based on tried and tested technical analysis, and where in this particular case price action may set up for a sharp reversal, but turns unexpectedly, in which case we will be able to catch a move in the opposite direction, in which case theoretically we will win no matter which way the price moves. This strategy works best when markets have consolidated or reached highs or lows which seem quite right for reversal or continuation in price action, but where the consolidation squeeze should cause a burst in volume in either direction. Example A. Let's quickly remind ourselves of the theory of the Elliott wave, which consists of an impulse wave which is usually composed of 5 subwaves that move in the same direction, followed by a corrective wave composed by 3 subwaves that move against the previous trend. Example B. Here we can see the Elliott wave in action. After a consolidation period, we can see that the Elliott wave, as denoted by the 1, 2, 3, 4, 5, 6 pattern, with higher highs and higher lows where we would expect price action to begin to fade, with our 3-part full pullback as denoted by the ABC technical pattern we have drawn as an estimation on our chart. Therefore, if the Elliott wave theory holds true, in this case at position A we would see a descent in price action in line with our ABC expectation, and if not, we would expect a price action continuation up to position 7 in continuation of the original upward trend. Example D. This is the first part of our hedging strategy, in which case we are going to go short at position A. This represents 50% of the pullback between positions 6 and 5, and at which point should be the beginning of a 3-wave countermove in the opposite direction of the trend, and should the Elliott wave theory hold at this point, we will capture some decent downward movement, especially if this setup is used on a 15, 30 or 60-minute chart. We must set our stop loss a couple of pips above position 5. Which would mean that the Elliott wave theory has not held out on this occasion, and that price action could easily set in the continuation upwards of the original trend. However, should position 5 on your chart be a round number, and what is also called a big figure number, such as the 1.3400, which you might see on the USD CAD pair, or the 1.300 in the USD pair at the time of writing, then the price action might find this as a level of resistance and then fall anyway. But as the theory would be negated, we would suggest that you consider this and think about the exciting trade and wait for another Elliott wave setup. In either case, stop losses should not be more than 20 to 30 pips. Example E is our hedging strategy. In the event that the Elliott wave fails and price action continues, we must set a buy limit order a couple of pips above the previous trade stop loss in order to capture the move from position 6 to position 7 and beyond. If possible, we should monitor the move closely because as an insurance policy, we need to at the very least make the same amount of pips that we originally lost in the first trade. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.